When you are standing on the edge of a financial shortfall with an unexpected expense looming directly in front of you, the urgency to bridge the gap can overshadow the mechanics of how you actually get that money. You need cash to cover rent, fix a broken vehicle, or pay a medical bill before late fees compound your stress. In those high-pressure moments, financial products often start to look identical. You open an app, tap a few buttons, or walk into a building, and money arrives in your account to rescue you from immediate failure. But treating a modern paycheck advance as if it were just another traditional loan is a dangerous mistake that can reshape your entire financial trajectory. Understanding the foundational shift between borrowing money you do not have and accessing money you have already earned is the single most critical step in protecting your wealth, avoiding hidden fee cycles, and keeping control of your personal economy. The central problem begins with how traditional lending operates versus how modern earned wage access functions under the hood. For decades, the primary mechanism for short-term emergency funds was the traditional short-term or payday loan. Traditional loans are rooted in the concept of credit extended against future earnings. A lender evaluates your risk profile, checks your credit history or income stability, and agrees to front you capital that you do not yet own. Because the lender is taking on risk by giving you unearned money, they attach a price tag to that risk. That price tag comes in the form of interest rates, origination fees, compounding APRs, and severe penalties if you fail to meet the strict repayment schedule. When you take out a loan, you are creating new debt. This fear of unending debt creates massive hesitation when people encounter modern paycheck advance options. It is natural to assume that any tool offering instant cash before payday carries a hidden trap designed to strip away your financial freedom. However, the fundamental difference in how paycheck advances handle repayment completely removes the traditional rollover trap. Because a paycheck advance is tethered directly to your verified earnings and automatically reconciled on your actual payday, there is no mechanism to roll over a balance into compounding interest. You cannot accumulate accrued interest on an advance because there is no interest rate attached to the capital. However, even though a paycheck advance avoids the high-interest trap of a loan, it introduces a completely different psychological and practical question. How do you prevent an advance from ruining your next budget? This is where many users run into friction. The primary challenge of taking a paycheck advance is not interest rate risk, but cash flow displacement. If you draw out $300 of your pay a week early to solve a temporary issue today, your official paycheck next week will be exactly $300 smaller. Without careful management, this dynamic creates a usage loop. You take an advance in week 1 to cover an emergency. On week 2, your paycheck arrives reduced by that advance, leaving you short on your standard bills. To cover that new shortfall, you take another advance in week 2 against week 3's labor. While you are not sinking into interest debt or destroying your credit score, you are living permanently one step behind your actual earnings. You become reliant on constant liquidity access just to keep your basic living expenses afloat. Recognizing the difference between a high-cost debt spiral and a low-cost cash flow loop is essential for maintaining control over your finances. In contrast, modern paycheck advance models typically operate on a low flat fee structure, subscription fee, or voluntary tip model. Many employer-sponsored platforms charge zero fees to the worker, serving instead as an employee benefit paid by the employer to increase worker retention and reduce financial stress. Other direct-to-consumer apps charge a small fixed fee for an instant transfer, similar to an out-of-network bank fee, or ask for an optional tip. To make sure a paycheck advance serves as a helpful financial bridge rather than a recurring crutch, you need a clear, actionable strategy for how and when to use it. The first actionable takeaway is to treat a paycheck advance strictly as an emergency bridge for survival expenses, not as a lifestyle acceleration tool. Ask yourself a simple question before confirming any transfer. Am I unlocking these wages early to pay for a non-negotiable emergency, or am I pulling forward future money to spend on discretionary desires today? Using an advance to fix a flat tire so you can drive to work is an appropriate use of real-time liquidity. The second actionable step is implementing a mandatory adjustment to your upcoming budget the moment an advance is initiated. Because you know with absolute certainty that your next formal paycheck will be smaller by the exact amount you drew out today, You must immediately adjust your upcoming spending plan before that smaller paycheck hits your account. If you advance $200 today, identify $200 of non-essential spending in your next pay period that you will intentionally eliminate. Cut back on dining out, pause subscription services, or delay non-urgent household purchases for those next 2 weeks. By actively reducing your future spending to match your reduced future check, you absorb the advance within a single cycle and completely break the cash flow loop, restoring your full paycheck balance on the following pay period. The final takeaway is to construct a dedicated, isolated emergency reserve so that you eventually transcend the need for short-term liquidity tools altogether. A paycheck advance is a vastly superior, safer, and lower-cost alternative to high-interest predatory loans, but true financial peace comes from relying on your own stored capital rather than pre-accessing your labor. Start by using the stability provided by fee-free or low-cost paycheck advances to stop paying high loan interest and late fees. Take the money you save from avoiding predatory loan fees and direct it into a separate savings account until you have accumulated a buffer equal to 1 full month of basic living expenses. Once that safety net is established, you will have complete financial immunity, moving far beyond the need for loans or advances entirely.